Okay, welcome back, everyone. This week we want to address the question, when will interest rates rise? And what we're talking about here are Treasury rates and mortgage rates. We know the Fed funds rate is going to be close to zero for a couple years. The Fed has communicated as much. So rather, for example, what we're talking about here is the 10-year Treasury yield. The 10-year Treasury right now is in the 1.2% range. And many folks would argue, and I would concur with them, that over the intermediate term here, based on the Fed's current policy, a fair value for the 10-year might be more appropriately in the 1.75% to 2% range. So what I'm offering here are a couple clues, a couple things to look at, or potential catalysts, if you will, as to when the 10-year may go back up to that range. Whether or not you think it's a fair value range, it is a pretty well-documented resistance area for the 10-year Treasury yield. So this first slide here addresses a couple of the reasons why we have this situation where the 10-year Treasury yield is arguably well below where it should be from a fair value perspective, which again doesn't represent a historically high rate, but certainly higher than where we're at today. And the answer is, of course, we have a very simple supply-demand imbalance. There's just too much cash in the financial system, including at banks and money market funds, and all of that cash is largely chasing treasuries, for which we have a shortage, due, of course, to the Fed's open market operations, specifically their standing repo facility, and then also their bond buying program. Both of these remove treasuries from the system and inject cash back in. And again, that cash itself is looking for more treasuries to buy. On top of that, we've had unprecedented fiscal stimulus, which has been pumping money into the system. That too flows into deposit accounts in the banking system and also money market funds. And then lastly, we have the debt ceiling being reached. So with the debt ceiling being reached, this has resulted in a halt of new Treasury issuance, which is further exacerbating this whole supply-demand imbalance. So when is this going to change? Well, I want to offer three things to watch out for here, three potential catalysts that could result in the 10-year Treasury moving back higher. And the first of which, of course, is bank lending, as you can see here. And to review for some of the newer folks, when banks take in deposits on the liability side of their balance sheet, it results in reserve assets being created. On the asset side of the balance sheet, those reserves can be converted into loans or lending. But in the absence of opportunities there, banks still like to get a return on their money, so they invest in Treasury securities, largely. Other securities as well, but they generally need to have very safe balance sheets, so there's a very high demand for Treasury securities. And as you see here in the chart, loan growth has been very anemic here for the latter part of the pandemic. However, when this picks back up and banks start lending at a greater rate, which is demand-driven, I would say. Folks often ask, well, why aren't banks lending? Well, if consumers want loans, if businesses want loans, banks are typically very willing to lend, and we just don't have that environment right now. Unfortunately, we haven't gotten a lot of consistent guidance across the board from executives at banks. Some regions of the country are a little bit better than others, but overall it's still a little bit unclear as to when this turns higher. But I wanted to put this out there as something to keep an eye on, again, as a potential catalyst if you're looking to either trade the 10-year Treasury yield or looking for a very opportune time to rebalance your client's portfolio. Okay, my second item to watch out for would be reverse repos. And the background here is that when a bank has excess cash that they can't deploy into a loan or to purchase a treasury with, that cash actually earns interest from the Fed. That would be interest on required and excess reserves. However, not every financial institution, namely money market funds, are eligible for this. With money market funds, of course, they don't have reserves. And then for some other institutions, they're not eligible to earn interest on excess reserves. So you still have a large part of the financial system that has a lot of cash and nowhere to invest it. So in order to accommodate this demand for investments, the Fed has set up its reverse repo facility, which of course is open to money funds and other types of financial institutions. And as you see here, demand has been absolutely enormous. And what is actually happening here from a technical standpoint is the money market funds and other institutions are basically lending money back to the Fed using Treasury securities as collateral. The Fed pays these institutions an overnight rate. So it's not as good as a higher yielding instrument, but it at least allows money market funds and others to earn a rate of interest that is greater than zero. So I think this is a very clear indicator of demand for treasuries, and I don't think treasury rates are likely to spike until we see this start to go down materially. So this is certainly something you want to keep an eye out for. Okay, the last thing to watch, in my opinion, would be the negotiations surrounding the debt ceiling. In terms of background here, I think we said everything that needs to be said right at the outset of this presentation. But what I would add, which probably is also not a revelation, is that based on the current political environment, one would expect this situation to only be rectified at the very last minute. So what is the last minute? Well, according to Secretary Yellen, that would be somewhere in late October and early November. That's when their ability to fund the government using extraordinary measures should run out. So again, if you're looking to forecast rates here, maybe what we could be setting up for is a very late year rally in the 10-year Treasury yield after this issue is resolved and we see some movement on the other indicators that we've looked at here today. So hopefully this is helpful. As always, appreciate your time. Thank you.